All right, Sachin Tikekar joins us, President and Joint Managing Director with KPIT, to talk about the Honda joint venture. Sachin, good morning. Thank you for joining us. Your company has an 8-year tie-up with Honda, and now there's a digital transformation deal. How large is this deal? Is this an incremental deal, or this digital transformation is part of the existing relationship?
Good morning to you, and thanks for having me. We are very happy to announce our enhanced partnership with Honda. As you know, or you may know, that we've had this partnership with Honda for the last 7 years. And now what we have decided is to take the partnership to the next level. And this partnership is about what Honda calls software-defined mobility, which is essentially getting Honda vehicles ready for the next generation. And it covers multiple areas, typically areas of case, the connectivity, autonomous driving, shared and electric parts. And that's something that Honda has 2 phases in which they will do this with us. One is the first vehicle will be on the roads in 2025, and the second will be on 2030. So in short, Honda partnership has been there for the last 7 years. It's just that now we have sort of created a common view about how we can help Honda in their software mobility journey over the next 7 to 8 years. And this is in addition to all the work that we've been doing with Honda over the years.
So what changes in next 3 quarters and what changes in next 3 years because of this relationship? Can you quantify, let's say, a number, or can you quantify how the deal is going to be structured?
Yeah, I will. So again, it's an ongoing engagement and it's an ongoing partnership. And let me talk about what it means. Is as we have announced, by end of next year, during the course of the next financial year, the total headcount would be about 900 employees from KPIT side, covering mostly the vehicle system and software professionals. And that would be a substantial increase year on year. And after that, for the following 7 years, we'll take that number to somewhere north of 2,000 by the year 2030. That's the plan. And for that, what we are going to do is, we know what we are going to be doing. It's going to be about 900 employees, including the existing people. And then at the end of every year, we'll have a yearly planning session and we'll decide how much to grow depending on the priorities every year.
Observing on ground when it comes to your European as well as North American clients, whether or not client confidence, demand is still intact?
Oh, absolutely. If you look at what we are trying to do is we work with handful of vehicle OEMs, whether these are the car makers and truck makers, and we create long-term partnership. You may remember a similar partnership that was announced with Renault in Europe not so long ago, actually just 6 months ago. And before that also, we have had a couple of such partnerships in place, and they happen to be the ones from the US. So our whole model is to convert these top OEMs into similar partnerships going forward, where they know that we are going to be them with us for the next 7 to 8 years and more. And we also know that what is it that we have to do, and we get enough headroom for us to really make them plan better and make sure that we are able to help them be successful in their roadmap. Specifically to your question about Europe and Americas, the demand is very bullish for what we do in the technology sector, which is essentially helping OEMs with their software-defined vehicles or software-defined mobility. In America, we see tremendous engagement and demand from our existing clients, and it's the same from Europe. So, for the next, in the midterm, we see tremendous amount of growth coming from these handful of clients across the 3 geographies.
What about margins then? We've seen a range near about 14 odd percent levels around on a quarterly basis. With now falling attrition, improvement in supply side, can we hope that you better this number in the days to come?
If you look at the last 8 quarters, our EBITDA has improved almost every quarter. You're talking about okay, EBITDA has improved actually substantially every quarter over the last 8 quarters. And we believe that now that it's improved from 14% to 19%, what we want to make sure is we continue to make tremendous investments in the technologies, and we'll do that. However, if you take a midterm view, you take next 2 to 3 years, we see improvement going forward as well. So we will see what we call profitability growth. Obviously, the top line will grow in a very healthy manner, and profitability will also gradually grow over the next 2 to 3 years.
Offshoring mix currently, and what could it move up to?
Say that again, please.
Your offshoring mix, and what could it move up to?
What we do is we have global centers across the globe. There are centers that serve our clients in the US. Essentially, we do that from our centers in India as well as in Brazil. Similarly, in Europe, there are multiple centers, a couple of them in North Africa, some in Europe, and so forth. And in Asia, we have Thailand and India as primary centers, along with China. So if you look at high cost versus low cost, rather than offshoring, if we are almost getting to a level where it's a fine balance between keeping the client engagements and making sure that we continue to work on the critical programs and we don't miss out on the key deliverables. That calls for a lot more presence along with the client. At the same time, there is enough of work that we can do from our global center. So the ratio has improved quite a bit in the last couple of years. Going forward, there will be a marginal change year on year, but we don't see that growing at the same pace that we have seen in the last couple of years.
Okay, Sachin, great to have you on the show. Thank you so much for taking the time out and joining in with your thoughts on where business is headed right now. And no problem with the North American or, for that matter, European client list.